Let me start with a number. $119. That is what one barrel of oil briefly cost this week. Not during the 2008 financial crisis, not when Russia invaded Ukraine. Right now, this week, March 2026. And if you think that number only matters to oil traders and hedge funds, you are about to find out just how wrong that assumption is. Because $119 oil doesn't stay in the commodity markets. It crawls into your gas tank, your grocery cart, your mortgage rate, your airline ticket, and your retirement account. And it does it fast. So in the next 10 minutes, I'm going to show you exactly where that $119 barrel hits your wallet, what it means for your money right now, and what you should actually be doing about it. Section 1. How oil got to $119. First, let's get everyone on the same page about how we got here, because this didn't happen in a vacuum. On February 28th, the United States and Israel launched a coordinated military strike against Iran, targeting nuclear facilities, military infrastructure, and Iranian leadership. Iran's supreme leader was killed in the opening strikes. Iran retaliated by launching hundreds of drones and ballistic missiles across the region and, this is the critical part, closed the Strait of Hormuz. Now, if you don't know what the Strait of Hormuz is, here's the one sentence that matters. It is the narrow waterway through which more than 20% of the entire world's oil supply travels every single day. About 15 million barrels of crude oil pass through that strait daily. When Iran closed it, roughly 200 tankers became stranded. Iraq cut oil production. Kuwait halted exports because storage facilities were filling up. Qatar declared force majeure on liquefied natural gas shipments, affecting 20% of the world's LNG supply. Saudi Arabia's massive Ras Tanura export terminal shut down after drone strikes. In the span of about 10 days, a huge chunk of the world's energy infrastructure either went offline or became inaccessible. The result? Brent crude, which was sitting around $70 a barrel when the war began on February 28th, spiked to $119.50, its highest level since the summer of 2022 when Russia invaded Ukraine. That's a 70% price increase in under 2 weeks. And for context, Macquarie Research says if the strait stays closed for just a few more weeks, oil could push to $150 a barrel or higher, which would surpass the all-time high set before the 2008 financial crisis. Section 2. Your gas tank, 230 to 345. Let's start with the most obvious and immediate place this hits you, the gas station. The national average for a gallon of regular gasoline hit $3.48 on Monday, up 16% from just a week ago. That's roughly 48 cents more per gallon than you were paying 7 days ago. Diesel, which is the fuel that powers the trucks that move literally everything you buy, jumped even harder, hitting $4.66 a gallon. That's up more than 80 cents in a single week. Now let's put that in real numbers. If you drive an average American vehicle and fill up once a week with a 15-gallon tank, you're already spending about $7 more per fill-up than you were last week. Multiply that over a year, and you're looking at $350 to $400 more just on gasoline alone, and that's if oil stays where it is today. If oil climbs toward $150, which analysts aren't ruling out, the pain at the pump gets significantly worse. The historical rule of thumb is that every $10 increase in oil prices per barrel adds roughly 25 cents to a gallon of gas. We've already seen nearly $50 worth of oil price increases in 10 days. Jim Cramer said it plainly on CNBC this week. This is going to cut into consumer spend. It always does. And he's right. Historically, every time oil has spiked over 100% from its base price as rapidly as it has now, the S&P 500 has taken a significant hit. We've already seen that. But the consumer spending effect follows the gas price effect, and that's where the real long-term damage happens. Section 3. Your grocery bill, $3.45 to 5 o'clock. Here's the part that surprises most people. Oil prices don't just affect what you pay at the pump, they affect nearly everything in your shopping cart. And here's why. Think about the journey that a food product takes from farm to your table. Tractors run on diesel. Refrigerated trucks delivering produce, meat, and dairy to distribution centers run on diesel. The ships bringing imported goods into American ports run on fuel oil. The planes shipping time-sensitive cargo run on jet fuel. Every single step in that supply chain just got more expensive simultaneously, but it goes even deeper than transportation. Petroleum is a direct input in the production of plastics, fertilizers, pesticides, and packaging materials. When oil goes up, the cost to manufacture the bottle of salad dressing, the plastic wrap on your chicken, the fertilizer on the wheat that made your bread, all of that goes up too. It takes time for these costs to show up on grocery store shelves, usually 2 to 6 weeks, but they are coming. Economists are already warning that we could see another meaningful pop in food prices in April and May, layered on top of an existing inflation burden that Americans were only just beginning to see improve. Egypt, a major wheat exporter, has already declared its economy in a state of near emergency due to the oil shock. Developing nations that import both food and oil are being hit especially hard. And while America is more insulated than most, higher global commodity costs always find their way to the American consumer eventually. Section 4. Your mortgage and the housing market, 5 to 6:30. This is where things get really painful for a specific group of Americans, and particularly painful given the timing. Here's the situation. Just 1 week ago, mortgage rates had finally, after years of pain, dipped below 6% for the first time since September 2022. The 30-year fixed-rate mortgage touched 5.98% on February 28th, the very day the Iran war started. Homebuyers were finally seeing relief. Real estate agents were seeing more activity. There was genuine optimism that the spring 2026 housing market would finally shake off 3 consecutive years of declining home sales. Then the bombs dropped, literally. And mortgage rates, which track the 10-year Treasury yield, immediately started climbing back up. By March 5th, the 30-year fixed was back above 6%. Today, March 10th, the 10-year Treasury yield is trading around 4.12%, and mortgage rates are moving up with it. The reason is straightforward. Oil price spikes create inflation fears push bond yields higher, and higher bond yields directly translate into higher mortgage rates. The correlation between energy prices and the Consumer Price Index, America's main inflation measure, is 0.96 according to Deutsche Bank. That is nearly perfect. For a home buyer looking at a $400,000 home with a 20% down payment, the difference between a 5.98% rate and a 6.25% rate adds roughly $65 per month to their payment. That's nearly $800 a year. Over the life of a 30-year mortgage, that's over $23,000 in additional interest. The window that briefly opened in late February has already started closing again, and if oil stays above $100 and inflation expectations continue rising, rates could push back towards 6.5% or higher, freezing the housing market all over again. Section 5. Your travel plans and airline tickets, 6:30 to 7:30. If you've got summer travel plans, start paying attention closely. Fuel typically accounts for 20 to 30% of an airline's total operating costs. When oil surges 70% in under 2 weeks, that is not a cost airlines can absorb quietly. Delta, American, Alaska, United, and Southwest are all already down 2 to 3% in the stock market just this week, and that's before they've had to fully grapple with the new fuel cost reality. Across the Atlantic, European carriers got hit even harder. Lufthansa, Ryanair, EasyJet, and IAG all saw stock drops ranging from 2.4 to 6% in a single session on March 9th. What this means for you is straightforward. Airfares are almost certainly going up, especially for summer travel. Airlines will either raise ticket prices, add fuel surcharges, or both. The routes most affected will be long-haul international flights, where fuel is the dominant cost. If you're planning international travel this summer, the smartest move is to book now, before the higher fuel costs fully feed through to ticket prices. Some analysts estimate we could see 10 to 15% increases in average airfares over the next 6 to 8 weeks if oil remains elevated. Section 6. Your investment portfolio, 7:30 to 9. Now let's talk about what this means for your investments. The stock market story of this oil shock is really a story of extreme sector divergence. Some areas are getting killed, while others are quietly surging. On the losing side, we've already talked about airlines. Add to that the broader financial sector, down 10% for the year in 2026. Private credit giants like Blackstone, Apollo, KKR, and Ares are down between 26 and 33%. Consumer discretionary stocks, the companies that sell you things you want but don't necessarily need, are getting squeezed as consumers redirect spending toward energy. Cosmetics brands like e.l.f. Beauty are down 8% in a single week, caught in the triple vice of higher petroleum-based input costs, rising shipping costs, and a consumer pulling back. On the winning side, the picture is very different. Defense stocks, Lockheed Martin, RTX, Northrop Grumman, are up 3 to 4% month-to-date and climbing. Energy companies, domestic oil producers and refiners, are obviously benefiting from the price spike. Gold is rising strongly as the classic safe haven asset. The US dollar index has gained nearly 1% and is at its highest level in 5 weeks as global investors seek safety in American currency. And despite the chaos, tech stocks like Broadcom and AMD bounced hard on Monday, up over 4.6%, suggesting that investors view high-quality growth stocks as a relative safe harbor. The critical question for your portfolio is, how long does this last? Kramer said he was not ready to rule out $150 oil. Oxford Economics predicts prices will fall to an average of $80 for the quarter if the conflict resolves. Macquarie says $150 plus if the strait stays closed. The honest answer is that nobody knows, and that uncertainty itself is priced into the VIX, which topped 30 this week for the first time since last April's tariff shock. A VIX above 30 is the market's way of screaming, "We do not know what happens next." Section 7. What you should actually do. 9 to 10:30. So given everything we just walked through, what are the concrete, actionable things you should actually be considering right now? Let me give you 5 of them. Number 1. If you are in the market for a home or have been thinking about refinancing your mortgage, the next 2 to 4 weeks matter. Rates briefly dipped to their lowest since 2022 and are now climbing back. If you can lock in at or below 6.25% before inflation expectations push rates higher, doing so now beats waiting and potentially facing 6.5 or 6.75% later. Number 2. Book your summer travel now if you have concrete plans. Airline tickets are going up. The question isn't if, it's how much and how fast. Locking in fares today, before the full fuel cost impact hits ticket prices, is likely the cheaper option. Number 3. Take a hard look at your portfolio's energy exposure. This is not investment advice, and please talk to a financial advisor before making any changes. But understanding whether you are overexposed to sectors that are oil price sensitive, such as airlines, consumer discretionary, and transportation, is smart risk management in this environment. Number 4. Build some cash buffer in your monthly budget for the next 60 to 90 days. Gas, groceries, and utilities are all moving higher. Having an extra $200 to $300 per month set aside as a buffer will reduce financial stress as these costs cascade through the economy. And number 5. Watch for the G7 Strategic Petroleum Reserve decision. The G7 said they're ready to take coordinated steps to stabilize markets. If they announce a major coordinated reserve release, similar to what happened after Russia invaded Ukraine, it could knock $10 to $20 off the oil price almost immediately. That would be a significant positive catalyst for markets and consumers alike. This is worth tracking daily. Let me bring this home. Oil at $119 is not just a number on a commodity screen. It is a tax on every American. It's the extra $7 you're already paying at the pump. It's the higher grocery bill that starts showing up in April. It's the mortgage rate that crept back above 6% and is threatening to go higher. It's the airline ticket that's about to get more expensive. And it's the portfolio that's gyrating violently as the market tries to figure out whether this is a short, sharp shock or the beginning of a prolonged stagflationary crisis. The good news, if there is any, is that the United States is in a relatively better position than most. We are a net exporter of oil. Our domestic production buffers some of the pain that would otherwise be far worse, and markets have shown that they can recover quickly from geopolitical shocks when the shock resolves. If this conflict ends in the coming weeks, oil retreats, inflation cools, the Fed resumes its rate-cutting path, and the spring housing market may still have its moment. But if it drags on, if the Strait of Hormuz stays effectively closed, if Gulf state oil infrastructure stays impaired, if Iran's new leadership digs in, then we are looking at a prolonged period of elevated energy costs, renewed inflation, and a Federal Reserve stuck between raising rates to fight inflation and cutting rates to prevent recession. That is the stagflation scenario, and it is the one Wall Street is most afraid of right now. Watch oil. Watch the Strait of Hormuz. Watch what the G7 does with reserves, and watch the 10-year Treasury yield, because that is the single number that will tell you where mortgage rates, the stock market, and consumer borrowing costs are heading next. If this breakdown was helpful, please hit the like button. It helps this analysis reach more people who need it. Subscribe so you get our next update as this situation develops. And drop a comment below. Are you changing your financial behavior because of $119 oil? I read every single one. I'm your name, and I'll see you in the next one.